So today we're doing the ETF Think Tank Happy Hour. I'm calling in from Atlanta, actually at a TGI Fridays. So forgive the background, everybody. My name is Dan Weiskopf. I'm the ETF professor and member of the investment committee at Tidal Financial Group. And today we're very fortunate to have Lee Shaiman on. And Lee brings just, without exaggeration, decades of experience, hands-on in syndicated loan market. And so Lee, so much, thank you for joining us. I think that this area brings a lot of indications of how things are going, and we'll cover everything from new regulations to Elon Musk's successful financing, to just generally what the market is telling us. And so I'm going to hand off the mic to David, and then send it back to me, I guess, Cynthia and Mike, for me to start off with the first question. David?
Oh, he's already claiming the first question, folks. How's it going, everyone? David Chikansky here, portfolio manager alongside these amazing humans at Tidal Financial Group, focus on the SoFi Be Your Own Boss BYOB ETF and the Amplify Inflation Fighting ETF IWIN. And today should be very interesting. This is a growing market space in the ETF space, specifically from flow perspectives. Just a massive space that I think advisors are allocating to, but sometimes don't fully understand. So hopefully we can get into details here, and I'll kick it off to my colleague, Cynthia.
Hey everybody, Cynthia Murphy, head of research for the ETF Think Tank. You guys all know it. I love Thursday, so I'm excited to be here. And I am running the attendees panel chat. You also know what that means, like holler, flag, smoke signal. Make sure you let me know if you want to talk, because I only partly see all this stuff. So welcome everybody. Go, Mike.
Hey folks, Mike Venuto here. I'm the co-founder of Tidal Financial Group and all the things that support the ETF Think Tank and entrepreneurs in the ETF space. I'll be helping out with the chat and everything. So if you've got something to share, go ahead and hit us up in the Q&A or in the chat there, and we'll get you up here at some point. I guess, Dan, before we go to you for the first question, why don't we let Lee introduce himself, and then you can jump back in. So Lee, the floor is all yours.
Okay. Thank you, Michael. Thanks everybody at ETF Think Tank for inviting me today. I appreciate it. I'm Lee Shaiman. I'm the executive director of the LSTA, which is the Loan Syndication Trading Association. We're a 27-year-old financial trade association that really represents the syndicated bank loan market. We have about 600 institutional members. And it's really a who's who of both the sell side and buy side of the syndicated loan market. So all the big banks and investment banks that are typically originators of corporate bank loans in the leveraged finance space, and all of the large institutional asset management firms, as well as many different size firms around the country. We focus on the US dollar leveraged loan marketplace. And we really are sort of a standard setting advocacy organization in and around corporate bank loan market.
Thanks, Lee. So you and I met, I think it was in 2014, when you were running SRLN. Okay. I guess my first question is, because I think often people don't know enough about this marketplace, this size, and why it's even important and how it can be used. So if you would, just give us a fundamental overview.
Sure.
Of the marketplace. Thank you.
Yeah. No, so that's right, Dan. We met. I was the first portfolio manager at the launch of SRLN back around that time. So the bank loan market probably then was under $1 trillion. The corporate bank, the syndicated bank loan market was under $1 trillion back in those days. I think today the corporate syndicated bank loan market is about $1.4 trillion in size. And what the market really, what the market has mostly done is it typically finances leveraged corporate companies. It's one of the biggest providers of financing to leverage buyout transactions at the top of a corporate debt stack. So banks typically originate loans to companies, and then they syndicate a majority of that bank loan to a group of institutional investors. A bank loan is not a security. It's a loan. It's a contractual obligation by the company. And then typically institutional investors will acquire a divided interest in that entire loan, typically by an assignment of a discrete portion of the loan. So when a fund is an investor in a corporate bank loan, they actually are a lender to that borrower. The relationship between the borrower and the lending group is managed by usually by that originating bank, often called the agent bank, and they act as administrative agents. So the bank collects interest payments, the bank distributes those interest payments to the borrowing group, the bank does the same for principal payments, and then because bank loans are relatively flexible instruments in their agreement between the borrower and seller, there are often waivers, amendments, and lots of activity that has to be managed through the course of a bank loan.
So before anybody goes next, just as a reminder, syndicated, I think is the word.
Oh,
For drinking
I didn't know we
purposes.
had a word. I came on late.
Yeah. Good catch. Forgot about that. and Lee already said it about 4 times, so you guys have catch up.
Wow.
All right, so I'm going to jump in. I love how you started with these aren't securities, because it lends to what an accomplishment it was when the funds that the ETFs that have access to these came out. I always remind people these all came out after 2008, right? Like pre-2008, the senior loan market was mostly insurance companies, right? They were the buyers, and in large institutions, I'll say.
Yeah, there were
Yeah.
some open-end
Yeah.
mutual funds. I think Van
Yeah.
Camp and Merritt was one of the early ones. Eaton Vance was one of the early ones. I think some of the very, very early funds going back into the 90s were actually interval funds, because it was difficult, to settle. Bank loans are quite cumbersome to settle. There is plenty of liquidity in the bank loan market. About $900 billion of bank loans turned over last year. So there's a lot of liquidity, but settlement liquidity is what's the word I'm looking for? Challenging, I guess.
Complicated.
Yeah, complicated.
Yeah, I remember in 2008, the way you got the exposure was through closed-end funds if you were a retailer or RIA. And these things traded to, down 70 to 90% in 2008 because the whole market kind of froze up, but you also had the discount issues. So, the fact that people were able to figure out how to get them into ETFs so that, you could have some price discovery was quite impressive. So having managed one of these, settlement you mentioned as an issue, what other issues does the kind of ETF wrapper make a little less cumbersome for people trying to access this unique market?
Well, I think ETFs. So when we launched SRLN was interesting because it was actually the first active bank loan ETF. So it wasn't a pure beta product. And the way I looked at it was actually an open-end mutual fund in an ETF wrapper, which I think was the best of both worlds, in so much as you had the ability to both redeem and create through the market, but also do it mostly in cash. I mean, we talked about this just before we opened up with Dan. You know, ETFs rarely do in kinds. It's
Well,
bank
fixed
loan
income,
ETFs.
rare.
Bank loan ETF. I misspoke. Sorry. Thanks for correcting me, Michael.
Yeah.
Bank loan ETFs, like you say, like most fixed income ETFs, rarely in kind create or redeem. But I think, you know, the challenges were, the one thing I think we made sure of was that we had a liquidity line available, and we had ample liquidity available in the event that there was a huge drawdown. I think, I was no longer managing. I was already heading the LSTA when we hit March 2020 and the big drawdown that we saw as a result of the COVID shutdown. But not a single bank loan, open-end mutual fund, or ETF, missed a redemption during that period. So while bank loans are challenging from a settlement liquidity perspective, the market found a way to settle bank loans sufficiently, and I think very few, if any, that I'm aware of actually drew on those backup liquidity lines. So, I think the market the market has grown sufficiently that it did make these types of daily liquid instruments be sensible ways to obtain exposure to the asset class. And I think what's really interesting is, the advent of the active product, that, using the ETF as a way to try to create some alpha, or at least reduce the beta exposure. And the way we did that was, it was really not owning assets that were in the index that we thought were not going to perform. So, and I think that, that's proven. I think if you look at the growth of SRLN over the last few years, particularly when you look at it versus BKLN or some of the other pure beta index product, you can see that there has been a migration, and that, I've always felt that funds follow returns. So, I think that has proven, that style has proven out. Not hearing you, Michael.
I think Dan has a question.
Yeah,
Yes.
I was kicking it to TGIF over there.
Very cute. Yeah. So part of what you were talking about, what earlier in the show, was, what is alpha in this space, right? And it's risk management for sure, is what you were highlighting.
Right.
We can all kind of mesmerize or even poke fun, or just be amazed by Elon Musk, but here, in order to finance his deal, he went to the syndicated loan market, and the banks, to a large degree, put it on their balance sheet. Talk to us a little bit about how a syndicated bank loan like that is viewed by the marketplace, when it's, candidly, it seems to be pretty difficult to predict the outcome.
Right. So I think there's two things going on right now, Dan. I think one is the markets, the volatility in markets, and the concern about the macros in particular, and a bunch of regulatory challenges broadly, particularly from the SEC, has, and of course, the continuous lift from QE to QT, has definitely impacted the syndicated loan marketplace. So we're already seeing a pretty tough year. I mean, when you think about, bank loans, first of all, when you look at returns, there's two components that go into the interest rate. There's the base rate. It used to be LIBOR. It is now SOFR. And then you can, I don't know, Cynthia, maybe you're probably not in a position to do this, but I'm sure you can send out a chart to everybody that, plotting the growth, and we just had a 75 basis point increase. and the correlations of, what's happening in Fed funds to those short-term rates are, very close. So we just had our fourth increase by the Fed. So we've gone from essentially zero base rate, very small base rate, to where are we now? About close to 4%. Yeah, we're close to 4% on the base rate. And then because of some of the challenges and because of some of the worries on the economy, we're starting to see credit spreads widen out as well. So you're going from, an all-in yield or return or margin on a loan from about, let's say, if we actually had LIBOR floors when LIBOR was effectively zero or a few basis points, and those floors were about 100 basis points. So maybe the all-in return on a loan was about 450 basis points. Today we're in the sevens, right, between the base rate and the margin. But so, and a lot of that, and we've also had a very big slowdown in primary issuance by corporate borrowers. Part of that's, you've seen the slowdown in M&A, so that's clearly a big driver of it. The increase in rates, companies are not turning those loans over because loans are very flexible, so there's often a lot of repayment and prepayment. Companies can take advantage if credit spreads tighten. They can take advantage of that tightening by refinancing, and that was a pretty common thing to do. So we've got a market right now that's slowed down a lot, and the average dollar price in the markets in the low 90s for the $1.4 billion of loans out there. So that loan that the banking group led in underwriting for Twitter is probably underwater today when you think about where it was underwritten.
I actually think it just got downgraded to junk.
Oh, it just did. So
yeah,
you've got
it got
the triple C. Okay, so then that's another issue. Depending upon where it's rated. So if it's rated below B minus, it's really tough for CLOs to own it because CLOs are very constrained portfolios. These are collateralized loan obligations for those that don't follow the acronym, but CLOs are about 70% of the buy side for the leverage finance market or syndicated loan market. So we got syndicated in there again, guys. Drink up. So I think the banks are looking at this thing and all the volatility in the markets generally and the volatility around the credit itself. And, I don't know much more than you guys know, but what's been reported in the papers is that the banks, as you said, Dan, the banks intend on holding. And I think I don't have the exact number in front of me, but I think there's somewhere around, of the 40 some odd billion dollars that Musk paid for Twitter, I think about 7 billion is term loan B, which would typically be sold through syndications to institutional investors.
actually fun fact. A slice of equity of Twitter ended up in Kathy Woods' closing interval fund as well, which now owns the. And I'm just curious what price that actually went down at.
I didn't see that.
He's not going to know that.
Oh yeah.
Yeah, I think she'd be better off owning the loan. I don't know where the liquidity is going to come from. There's a bunch of questions in the chat from Warren that I think go back to the basics of these things, right?
Yeah.
So people hear senior, do they have some sort of guarantees? Do they have kickers? Is there collateral against these? Like, what makes these instruments senior, right? Like, I mean, that was even like the ticker even implied senior.
Yeah. So those are all great questions, Warren. And actually it's good you asked because I think I blew right through this. So senior secured bank loans so the syndicated bank loan market are senior secured bank loans. So they're top of the debt stack of corporate financial structure. They're typically senior to everything but, Uncle Sam and the employee and payment to the employees in a liquidation. They're usually secured by all or most of the corporate assets, including IP of the borrowing entity. They typically don't have insurance guarantees. I mean, these are highly levered companies, so you're not going to find an insurance company that's willing to wrap that, because there's just too much. There's too much risk, and for an insurance company to do that, and be able to keep up with its own regulatory capital requirements.
Lee, are these loans typically viewed as being highly correlated? Sorry, not highly, but correlated with inflation in how they should be expected to perform because of the interest rate going higher?
Yeah. So
Variability.
So historically, and I think the market we're in now is a little bit of a break with the longer term history. Historically, bank loans have outperformed in periods of rising interest rates because of the floating rate nature. So again, going back to how do you get paid aside from principal, but interest is a base rate, typically, historically LIBOR, now SOFR, the secured overnight funding rate. And that's usually a term rate, so it's either a 30-day or 90-day, I guess, for SOFR. There used to be LIBOR used to have a 30-day, 60-day, 90-day. I mean, LIBOR, you could go out a year, but it typically wasn't priced off. It was usually priced off of no more than 3-month LIBOR. And then there's a credit spread. So what you do have is you have some spread duration, but you really don't have, you don't have duration risk that you typically have with a fixed rate bond instrument. What you do have, however, is, you have a lot of credit risk. These are typically levered companies.
Yeah, but so past interest rate cycles, isn't it a little bit of like a bias of just like the opportunity set of the majority of these interest rate cycles that this market's been around have been from trying to slow down growth, not trying to fight inflation? Am I wrong about that? The credit spread comes after the interest rate hikes normally, and this time the credit spread is coming within the spike in interest rates, isn't that?
Yeah. So I think if you really look at this market, the syndicated bank loan market didn't really exist in the days that Paul Volcker was Fed chairman and they broke the back of the inflationary spiral. Okay, so you've got a bit of a different paradigm, but we have had periods over the last 25 years where the Fed did raise rates. Really before the global financial crisis, while we didn't have that tremendous inflation, we did have periods of rising interest rates and Fed tightening, and typically bank loans outperformed. I think where you run the risk, and I think where the market is choking a little bit, to the extent that it's choking, is I think that there's very strong expectations of a recession. So then the question is, how deep a recession and how much of an amplifier being levered will mean, which is we're coming off of periods where credit default cycle has been very light, especially post the pandemic period where the government has just been so accommodative. And we've really only seen defaults in companies that were already in trouble pre-pandemic. Companies like Revlon, companies like Avaya, the companies that have really rolled over, and they've been in trouble, frankly, for a long time. They've been kind of on life support because of easy money and low interest rates.
We call them zombies.
Zombies. And we call them zombies too. So, we've had a lot of zombie companies that have managed to continue to stay out of default. They're pretty low rated. A lot of them have managed to eke by and stay at sort of mid-single B, and that's really the heart of the leveraged loan market today, is rated about single B flat if you look at an S&P scale, B2 on a Moody scale. There's been, there has been rating degradation or credit degradation as measured by corporate ratings for quite a while. I mean, if you look at the high yield market, which is the closest cousin to the syndicated bank loan market, you know, the average rating on a high yield bond is probably low double B. So credit risk is theoretically lower, but but high yield bonds are typically not secured. A good part of the market is senior, but senior unsecured. So, there's a big difference in if a company does go into default, what recoveries are likely to be. So I think where we are in the market, and I think this reflects back, I'm being a little long-winded, I think, in answering Dan's question, but I think what the market's reflecting with respect to Twitter, and I think you made some commentary that's is accurate in the way people are thinking about it is, if we get into a recession, the default cycle increases, and we don't have as good a feel as to where recoveries are likely to be. The market's more levered. I think we're more levered to enterprise value than we've ever been before. And how much of that enterprise value has been inflated by, monetary policy, easy money. I mean, I'm sure a lot of the folks on this call are, invest in equity ETFs. I mean, you've seen that. And if equity valuations start backing down, recoveries are going to come down. And if you're 7 times levered against, there's not a lot of cushion below, and that's probably going to impact your recovery. So I think right now what we're seeing is we're seeing a lot of the market reflecting concern over defaults and recoveries, because they feel that while interest rates need to rise to deal with inflation, they're rising pretty quickly, and to break the back of inflation, if you believe Chairman Powell and the FOMC, we're probably going to see a few more increases. They're probably going to slow down. I think they've been signaling that they're likely to slow down and see how this all plays out. But, we think that this is going to have an impact on the economy. And, levered companies, when the rest of the economy catches a cold, the levered companies get the flu.
We have 125 basis points left priced in, so he's going to slow the pace. I think inferring no more 75s, but if you saw the market after the announcement and then during the speech, it was fascinating. When like Qs were down 30 bips, up 1% right after the announcement, and then his speech came on and it swung 400 basis points in the other direction. It's pretty fascinating. So potentially stupid question. Why is there not more energy exposure here? Could it just be lack of issuance? Like I looked through like some of these ETFs and I'm just like, we do like lower credit in relative to traditional high yield. We do like the energy sector in that space because it seems like it has a little bit of a floor on it. And I'm just kind of surprised that more people aren't jumping in on that.
In bank loans, there was a downshift in energy in particular. We had a pretty big flush out. I guess it was 2017 in the energy space. We had a lot of the guys in the fracking parts of the country, particularly some of the service companies and some of the aggressive E&P guys got crushed on commodity price moves. And I think it's once bitten, twice shy, and it was always a smaller space. It's a tough area to lend money on bank loans. It's you get the price deck moves, and they whipsaw, and so I think you just have a lot less issuance, and you're going to have a lot less issuance for a long time in that space. I would say anybody who owned any energy exposure in 2017 in the bank loan space, for the most part, took some hits. So that I think that answers your question, David.
I was gonna follow it just, I just coincidentally, I was talking earlier today with somebody who was looking at ETFs in the space, which it's so far from my expertise, it's not even funny. So I'm doing a lot of listening today and talking very little. But the one comment he was making about the way we were earlier, we were talking about how ETFs opened access to this part of the market, but his criticism was that most ETFs in the space, BKLN and SRLN, and I think there's FSTL.
It's like 5 ETFs, I think,
Yeah,
or 6.
that they tend to really focus on your 100 top loans, which is where most of the risk is. If something blows up, they're more likely to blow up. They're very levered. And that people aren't really aware of that massive risk. And as the cycle moves on, as you get later in the cycle, he was making this case for you got to go active, because if you just go beta in the space on the ETFs you have today, you're going to be exposed to a lot of risk. So I just wondered, do you agree with that? Do you see that as a limitation to the access that ETFs are providing today?
So, before we got, I no longer own any of the bank loan ETFs. And so I don't pay a lot of attention to what the active guys actually own. But I would say that when, our whole story in SRLN, when I was managing that, was that you had to actively manage credit, and you just couldn't own the index, because the problem is they're just going to be, particularly when the economy rolls on you, there's just going to be names in the index that you're going to lose money on. So, the ability to actively manage, and I think that's the advantage of the active ETF product in the bank loan space versus the pure beta product, is, you kind of own the belly of the index, because otherwise a lot of guys won't buy an ETF product because, or at least the institutional guys won't buy the ETF product because they don't understand tracking error. They don't know how to predict it. They don't understand the reasoning for it. It becomes a much more retail type product as a result of that. But you kind of own the belly of the index. You own the credits that you feel through good times and bad are going to perform. And you try not to own, or you don't own, the names in the index that you just think are over levered or have a lot of risk to the economy and have a lot of risk to defaulting. And that's how I managed. And I think that's how Blackstone continues to manage SRLN. This is no commercial for that product. I'm just saying it's a style of management. And then you own other assets with it, then you fill in with names that are not in that 100, where you think you're going to get good performance, and hopefully, you continue to earn a dividend yield that's competitive, and, so produces, returns that are competitive with what investors would expect from just owning the pure beta product, without credit loss. So again, I think the way I think in your conversation, I think, in a less clinical way, the person you were speaking with, I think they're generally directionally correct. But I think you can do it in a bank loan ETF if it's actively managed. And then you've got to pay attention, or you got to talk to the manager and say, it's just like an open-end mutual fund. What are they doing? What are they buying? I mean, the nice thing about the ETF product from an investor's perspective is the transparency. What's in the basket. You don't know, in your open-end mutual funds, you don't know for 6 months when they report, what they own, and it's already old. They don't own all of those names, or they don't own some of those names by the time you get the portfolio. And so I think there are great advantages if you really want to understand credit, and you really want to or if you know a lot about the businesses and the companies, and you want to kind of hold the manager's feet to the fire. I think owning those active ETFs are an interesting way to own this asset class, because it gives you that liquidity, but it also gives you the transparency. So if the manager's not doing what they said they were doing, you'll know if you pay attention to the basket, to the portfolio.
Yeah, no, that's true. Dan, you have a question?
Yeah, I've got a question. Incidentally, I wrote something maybe 2 weeks ago about the group. If somebody can just pull it up and add it to the chat, probably be helpful. And then also did an interview with Gordon from
Gordon McKinney
Blackstone.
from Blackstone.
Yeah. Something that I don't fully understand is the duration issue on syndicated loans. You know, are some syndicated loans 3 years, some 5 years, some 30 years? It
Yeah.
would seem to me 30 years would be really long.
Yeah. So syndicated bank loans typically have a 5 or a 7 year legal final maturity. Most of them don't have very much amortization, at least in the first 3 to 5 years. The amortization is very, very minimal, effectively none. But because they're floating rate, if you look at bond math, there really is no actual duration because they reset every 30 or 90 days on the base rate. What you do have is what people call spread duration, credit spread duration. So when the loan is issued, credit spreads are a certain level for a certain amount of risk, and those credit spreads widen and narrow over time. So if we're in a period such as we are, where there are expectations that the economy is going to deteriorate, credit spreads are probably going to widen. So if you buy, so it goes back to your Elon Musk question earlier, your Twitter question earlier. If investors believe that the economy is going to get tougher, and they also believe that Twitter are going to get worse before they get better, if they get better under Musk's tutelage or control. Buying today at a certain spread is insufficient return for the risk and volatility that they're likely to experience. So you have those two elements in a bank loan. You really don't have bond duration, bond kind of interest rate risk duration, but you do have credit risk duration. The interesting thing about loans is typically in good times, or particularly in times when interest rates are declining, the average life of the loan is typically under 2 years. In other words, there's a lot of corporate finance activity or corporate capital type activity that really causes bank loans to be repaid or prepaid pretty quickly. So bank loans have very little call protection, unlike corporate bonds. Typically, a primary or a new issue today has got
okay, all right,
1 year of call protection or less. So if interest rates or credit spreads tighten, typically the company is very likely to refinance that loan and take advantage of, even if overall interest rates aren't declining, if credit spreads are tightening, they're likely to take advantage of that. The other thing is, because bank loans have lots of covenants and restrictions that bonds typically don't have, it's quite often that a company, if they're doing something, if there's a major corporate action taking place, asset sales, asset purchases, mergers, acquisitions, and so forth, that will typically cause a company to refinance or to pay off that loan. So, in times, and it's true in better economic times, you typically have a much shorter economic life to a bank loan. In times like we're coming into, people are expecting that the loan's going to stay out longer because there's less opportunity and less reason for the company to repay or prepay that loan. Did I answer your question, Dan? Sorry.
Oh, yeah.
Sorry.
I think
Talk too
Dan's
much.
silence suggests yes. You're rendering us all speechless, Len. That's what's happening. We wanted to bring up Eric, who has a question. I don't know. Are you still there, Eric? Do you want to come up?
I think he's probably getting off the boat there. He gets his
Is
during
that
his
and
commute.
is that the question in the chat about defaults?
Yep.
Yeah, I think it's a good one because oh, there he is. Go ahead, Eric.
Yeah. When there's a default, who bears the legal fees for resolving the credit? Is that the investors out of their coupon from the loans, or does that come out of the management fee?
Yeah.
And in general, what happens? Yeah, what happens when the cost of carry for the legal fees? What if it exceeds the income from the remaining loans?
Yeah, I mean, typically, if the fund continues to hold the loan through a workout, I mean, again, these are supposed to be, the expectation that particularly the top 100 loans in the marketplace, which is what most of the ETFs own. Although, as I said earlier, the active guys do move down further in the market. But typically, it's the fund bears a lot of the costs of that workout. The manager typically doesn't bear the cost of that directly out of their fees, as
I would guess just from seeing these, if there is an expense like that, Eric, most of these are going to jettison the bond and go find something else because their mandate's income. A non-performing loan's not going to meet their mandate.
Yeah.
So they're not really acting like the hedge funds that normally own these things. They're, acting more as
And more often than
an
not,
exposure.
When something defaults, it usually falls out of the index. Now it may come back in the index. The reorg securities, the restructured securities may be big enough to come back into the index.
So if there's a default for a heavily ETF-owned loan, these are going to get puked out, and you could see a bigger price response than your historical data might have shown you.
I mean, the one thing about the syndicated loan market is that open-end mutual funds and ETFs today are about at most 9% of the total size, outstandings in the market. The predominant owners of the syndicated bank loan market are CLOs. So I think where you see more price risk in this market is, and we talked about this, I think David brought this up earlier, is when credit ratings move around. So CLOs are very constrained and very dependent on credit ratings because there are collateral quality tests that have to be maintained. So if a loan gets downgraded, let's say it's single B flat, and it gets downgraded to triple C, you're going to see a lot of the type of price action that you were just talking about across the market, because a lot of CLOs are not going to want to hold that asset. And as we see greater and greater downgrades, you're going to see more and more indiscriminate selling on downgrades as opposed to just focused on credit, because a lot of these CLOs have caps on the amount of triple C assets they can hold before they actually suffer a diminution of collateral quality.
Okay. So I think I'm going to come in here for our last question of the day. And I think we've kind of teased around it a little bit, but it's interesting having you as a guest, because I would call you a reformed portfolio manager of an ETF, right? So, and we are the ETF Think Tank, so we've got these kind of angles that we're going to come back to. So, as a reformed or prior, you no longer have to deal with SRLN. What would you do different? Like if there was to be a senior syndicated loan ETF out there, what would you like it to do? Like, what would you do different in hindsight now? And should we launch one?
So yeah, look, I don't think, given the time, I mean, I think the one thing I would have done a little differently, I think we kind of got there eventually, but I think being a little bit more almost model focused in terms of how to optimize portfolio in an active structure. So it's sort of that balance between, what we were talking about with Cynthia before, tracking error and some of the issues that typical ETF investors are looking for because they're more accustomed to investing in a beta, instrument. So I think just the balance between trying to avoid credit risk, but trying to keep investors who are more accustomed to ETF style investing, basically, wanting exposure to the asset class, that's a little harder to manage. And I think just explaining that much more clearly up front with a lot of investors, and why, I think that's where I would have spent a little more time. I don't think I would have done anything differently today then, in hindsight. I think we did a pretty good job. We started with like 35 or 40 million of seed. When I left, we were $900 million, which is pretty good. I think I managed the fund about a year and a half before I left. And I think it's the largest bank loan ETF today. It superseded BKLN, which was a behemoth when we launched. What my advice to you is, don't do it now, and I'll tell you the reason. First of all, there are a lot of them. Secondly, and I talked about this with Dan earlier, there are a lot of regulatory challenges right now to this asset class that may resolve and may not resolve. And just yesterday, for those of you who pay attention to this space, the SEC released proposed new regulations on liquidity for mutual funds and ETFs. And because of some of the issues we spoke about earlier, settlement liquidity specifically, not necessarily liquidity, the ability to trade the asset, but the ability to settle for cash, the SEC has really honed in on this asset class, and it may come to pass that it's going to be quite difficult to maintain banks in a daily liquid product set. Very early days. I'm not saying it's, I'm not signaling the doom of bank loans held in a daily liquid fund format, but I think it's going to be really challenged. I would say to you right now, based on the proposed rule and based on Chairman Gensler's record out there over the last year and a half, and his targeting of our industry, both broadly and specifically, I think it's a tough road to hoe. And I think I'm not going to say whether or not the SEC has merit. I think that the asset class does have challenges, but the asset class has never missed a redemption. And we've gone through some pretty ugly drawdowns. David talked about, the global financial crisis. March of 2020 was no walk in the park for daily liquid product, particularly for this asset class. But we didn't miss a redemption, and we had a lot of assets. We also have a lot fewer assets held in mutual fund format today. Even though the asset class has grown, open-end mutual funds and bank loan ETFs are about 8 or 9% of the total $1.4 trillion of our market. So there are a lot of other institutional investors that like the asset class. Interestingly, I think it's a much broader buyer base or investor base today than it was certainly when I launched SRLN, and it's a much broader investor base than most other, smaller fixed income asset classes.
So what percentage of that, like 91, 92% are thinking the way Eric Connerly is thinking? And it's just like, I'm waiting for these things to fall out of the index. Like how many of those guys are thinking like Eric? Eric's now downloading all the holdings and getting,
I mean, look, I think,
we're teasing you, Lee. It's rhetorical. We always look at that angle. Listen, we want to thank you for coming on.
My pleasure.
We really appreciate you being here. You're making me think I need to figure out a way to get these loans on a blockchain so we can get the damn thing settled.
Yeah.
So maybe
Well,
there's
we've been
another
working
business.
at the LSTA. I've been working on that with a number of vendors, and I think I think we'll eventually find a way. I think there are a lot of challenges, and
Yeah.
and it's not just technology; it's behavior too. I think
Well,
the market's got to clean up its act.
all right,
All right.
folks. We want to thank you all and thank Lee, and we'll see you next week.
Thanks for having me. Cheers.
Thanks, Lee.
Thank you.
Be well, everybody.